Good morning. It's Monday, December 8th. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So, looking at silver, the contract high that we saw on December 5th, 59.90. So, silver futures, they did sell off in the early overnight trading session, getting down to a low about 57.77 before rebounding and snapping back. So, trading near 58.83 of this recording. So, we're about $1 off those all time highs at the start of the week, in which the Federal Reserve is widely expected to cut interest rates. Silver prices have found support from tightening inventories in London and in China, and strong industrial demand and some sustained safe haven flows, reinforcing that bullish momentum. So your key levels of support that I'm watching in the silver market include the December 4th low, 56.85, down to probably pocket support at 56.50, as I would expect a lot of stop losses being below that December 4th low. And then the next significant pocket support would be from 55 down to 54.50, and trend support at 52.87. That follows the 50-day moving average at 51.05. So quite a few different levels that I've got outlined on my charts over here. Now look at some of the precious metal, the ETF flows. Well, they were buying gold, this silver, and palladium, and they were selling some platinum. So silver futures year-to-date percentage change up about 18% here, rising about 0.4% from Friday's session. So the ETFs, they did add another significant amount, 3.64 million troy ounces, and it was a sixth straight day of growth. So the dip buyers are very active in that silver market. And if you look at that sell-off that we saw overnight, and you are a dip buyer, you got to ask yourself why you don't have a futures trading account, because of the fact that you can't do that on the ETFs here. So last week, the changes here, the big standout here was the ETFs, they increased their silver holdings by about 18.9 million troy ounces. That's a massive move into that silver market. And that's where you start to gather some structural support, because the silver prices, they're going to be stronger in strength and numbers here. You don't want to see just a couple key players in there. You want to see widespread adoption from different investors here, as they develop this different mentality of buying the dip on any kind of significant washout. That's why we've seen U.S. equity markets tend to be very resilient in some of the corrections, very short-term and shallow, because of the fact that there's so much buying going on in many of these different stocks. You can look at the way that 401ks and pension funds are continuously buying these Mag 7 names on a monthly, daily, weekly basis, regardless of what the price action is, because of the structure of the way these retirement plans and things like that are occurring. And that's where you get this adoption of having some of the commodities into wealth management portfolios, small slices of different commodities here to hedge against inflation, geopolitical uncertainty, to provide diversification, to keep up with inflation. We're seeing that, and as that comes into place, you're going to see the floor on many of the commodities across the board get lifted up, and that's what we're seeing in like the Bloomberg, the total commodity index. Now you look at the gold market, the exchange traded funds, they only added about 20,000 troy ounces of gold holdings, and total gold held by ETFs are up about 17% this year to 97.8 million ounces. That's the highest level since October 24th. You look at China's central bank, and this is where we talk about structural buying. They increased their gold reserves for the 13th consecutive month. That was according to data released on Sunday. And it's the People's Bank of China. They added about 30,000 troy ounces of the bullion last month, bringing its total to approximately 74.12 million troy ounces. The current buying cycle started in November of 2022. So many of these different central banks out there started to diversify away from holding concentrated FX positions. And it was specifically the Russia-Ukraine conflict when it started, when you saw Russia being sanctioned, you saw them being taken off of SWIFT payment systems. And what other countries saw is that their assets and their FX reserves were stored in the same locations as where Russia has it on different payment systems. And with Russia being taken off because of that, well, what's not to say that that particular country, someone like Saudi Arabia, couldn't be taken off of it. And that's where you start to see these different countries go, hey, we need to incorporate a hard asset, or at least boost that hard asset into our FX reserves. So you're seeing many of the central banks want to get to 20, 30% of their FX reserves and gold holdings. Now you look at some key levels of gold here, 41.44, that's your trend support. Additional support around the 50-day moving average, 41.18. The gold-silver ratio, more importantly, did drop to about 71 to 1 here overnight before snapping back just a little bit back over that 72. So you look at the broader picture on the markets here. You got stock futures. They are hedging higher. They were a little bit weaker here, and we'll see what happens here because we do have some big events this week here, including the Fed meeting where a rate cut is widely expected. You got earnings from Oracle, Broadcom, which could provide some year-end test for that AI narrative. So you look at S&P futures up about 0.1% as of 5:24 a.m. in Chicago, and then the NASDAQ up about 0.2%. Looking at some market insights here at the U.S. equities, they saw modest net purchases for the 5th straight week, with buying and long positions outpacing those short positions. That's according to Goldman Sachs prime data here in the week ending for December 5th. So most investors now are looking ahead to 2026. Over 3/4 of the asset managers polled in an informal Bloomberg survey are positioning for a risk-on sentiment through 2026. It's really the base effects, the comps, they get easier. The Fed is in this cutting cycle. We're moving past the tariff talks and things like that. The only real, in my opinion, thing that could really impact this market, U.S. equity markets, would be is if, the Supreme Court comes out and says that Trump's tariffs are unconstitutional, because I don't think that the equities are positioned for something like that, and that those tariffs were illegal. That would be a serious repricing of what's going on in these markets. Otherwise, much of everything that's come out here has kind of been soaked into the markets right now. So you look at the interest rate expectations, and this has been kind of interesting. So you look at the CME's Fed Watch Tool, you got an 87.4% likelihood that the Fed will reduce rates by 25 basis points at that meeting. So the Fed is in this blackout period. So you're not going to hear anything from any Fed officials until December 11th. But where things get interesting is when you look at the FX and the risk rundown, you got the dollar index, which has been sliding lower. You got the euro currency, which is sliding sideways to slightly higher. They had a hawkish inflation print, which caused them to look at pausing any kind of interest rate cuts here, where now we are starting to cut again. They were looking at cutting. Now they've got to hold rates steady. And then you look at all the other FX currencies. You look at like the Canadian dollar, the Australian dollar, all breaking out to the upside significantly. So that puts some pressure on the dollar index. You got the British pound. It shot up. Now it's kind of going sideways here. But it's the 10-year treasury yield. So you're hearing a lot about the Bank of Japan and their interest rates over there. Well, you're also seeing the yield curve steepen in the U.S. as well. So you get the 10-year yields up at 4.155%. So that seems to be teetering on a small breakout here. So what's happening is the short end is being anchored and the long end is continuing to extend higher, and it's steepening that out. So you get Bitcoin futures at 92,500. You get the S&P gamma exposure. Well, it's still positive gamma, indicating some lower index volatility here. Expect that volatility to pick up significantly around the Fed meeting, especially if we get this hawkish cut where they do cut, but they really hardcore indicate that they are easy continuing to cut those rates. You go over to Europe and Asia. Well, the European stocks, they were a little changed as investors adopted a wait and see approach ahead of that Fed rate cut here this week, and they're digesting those hawkish comments from the ECB. And then you get Asian stocks, they're edging higher. The MSCI Asia Pacific Index advanced for the 5th straight day, gaining about 0.4% before trimming some of those gains. So if you guys got any questions, if you didn't get the navigating the week ahead, I could resend that out to you. Also, we're going to continue to build on a lot of the research that we're putting out here, a lot of the data, a lot of the insights, more insights than anything, because of the fact that what we're doing is we grab a lot of different analysis from third-party vendors and we combine that together, and that's really what we're providing here with our own particular twist on a lot of things out here. There's a lot of great resources out there, especially within the Bloomberg terminal and things like that. So you guys got any questions, give us a call, shoot an email, info@bluelinefutures.com. And remember, futures and option trading does involve risk of loss, may not be suitable to all investors. Good luck, good trading.